Welcome to Global Financial Engineering. I am Dr. Glen Brown. In this session for our global weekly commentary, I want to look at the Euro-USD currency pair. Today, the 21st of January 2023, that's one day after the close of the financial market. So this will serve as a review and what we expect from a technical perspective going into the new trading week. In our previous session, that's the first video, we did an extended video to incorporate gold futures along with building the advanced 821 trading strategy. However, you would have noted that with the 821, where we look at the crossover with the 8 and the 21, there are times when you will get some false signal, or maybe you will get some signal that doesn't give you anything close to a 1-to-1 or a 2-to-1 reward to risk ratio. In this session for the Euro-USD commentary, I want to build on that advanced 821 strategy and give you some additional tools that you'll be able to use to determine whether or not you deem the market to be bullish within that trading time frame instead of moving over to other time frames. I believe we could stick to one time frame if we just put a little more confirmation indicators on that. So I want to do that, and the objective here is not just to comment on past market action. I want to use each session as an additional training ground where we engineer system from scratch. So for those of you who have not yet gone through the first video in the series, I'll recommend for you to do it so that you are able to follow the build-up of the system. And I'm going to reach at the stage where I will show you how we at Global Financial Engineering automate these strategies to give the global algorithmic trading system. So we're going to look at the Euro-USD pair. But before I move over to the practical session, as usual, there's always risk, and this video is strictly for educational purposes and should not be deemed as trading advice. So I want to put on screen for a moment our risk disclaimer. And maybe for those of you watching the the recorded version, that you could pause the video and read through this carefully. It is very important for you to be aware of the risk involved in this business. And yes, it is a business. It's a business that can change your life. Do it recklessly, it change your life for the worse. But do it with a plan and follow strict rules and money management. Over time, you should be able to see a positive impact on your life. So I want to give you a few seconds to run through this. Those of you who can pause it and go through it, it's important to be aware of the risk involved. And then after the time elapse, I will move it to the final section of the risk warning screen. Okay, so maybe you'd be able to read down to trading results. I'm gonna put the final version here. For you to read through. It's a detailed risk warning with many deliberate repeat phrases so that you are fully aware of the risk. And then for the US government required disclaimer regarding Commodity Futures Trading Commission, and also the CFTC rule about hypothetical simulated performance. I want you to be fully aware of that. And as usual, for those of you who might be going through this lecture, many years after its creation, you can go to our website, www.globalfinancialengineering.com. You could type risk disclaimer in the box and you will see any update that is required on this. Okay, great. So now that we get that out of the way, just to provide you with a little bit of who we are and what we do. So after many years of involvement in the accountancy, investment, finance, management, IT, we have decided to bridge accountancy, finance, investment, trading, and technology together to become a global multi-asset class professional proprietary trading firm. Of importance is that we do not offer any service or product to the general public at this time of recording of this lecture. We do not accept clients or external funds. But yes, we do have opinion of the market. And sometimes we do believe that we can give back something to provide guidance to beginners and maybe person advanced, but just want to have a view of how others see the market. So yes, we create these lectures in the form of commentary, and they also help our employees, a person who are employed to Global Financial Engineering or Global Accountancy Institute, to follow the leader. And this is a great platform for the advanced trainer or senior personnel at the firm to record their views on the global financial market. These videos are not necessarily short videos. We are not in any ace for them. So maybe I would say that these videos are not for those persons who just want to run into something and run out. We are not here for that. We are here to have a conversation. Okay, so let me then go with that out of the way, get to the platform as indicated to you. We will use the advanced 821 strategy and the EURUSD. And we call this strategy number 6. And the earlier version of the global algorithmic trading system. In version 1.04, this is strategy number Yeah, this strategy number 6 on the version 1.04, and the version 1.02 it would have been strategy number 5. So for those staff who might be looking at the earlier version, this is strategy number 6 and the new version 1.04, and it's simple. We just call strategy 1 and they run on the 1 minute, strategy 2 and the 5 minutes, strategy 3 and the 15 minutes, strategy 4 and the 30 minutes, strategy 5 and the 1 hour, strategy 6 and the 4. We can go up to 9 strategies. We believe that if you can give each strategy a name, it'll be easier for you to record, to keep a journal. Yes? Keeping journals, a record, is always important. It's not the number of winning trades that you have, because you can learn more from losing trades, where you analyze each trade that is closed, both the winners, but most importantly, the losers, because you can gain a lot of experience from losing trades. For example, let's go back in time to this 821 crossover here. And let's assume that you cross over. But when you cross over, you cross over at the end of this massive bearish candle, and you enter the trade here. A few things I want to bring to your attention. You might possibly enter the trade somewhere at the end of this candle or at the opening of this candle. If we look what is happening here, while we will have a cross down of the MACD from here, which is a early warning sign, but we don't follow all these signs when we are in a bullish market. We consider these to be retracement, and then we are pullback, and then we look to see how it reacts on the 21 EMA. It breaks the 21 EMA, so that means we break support. Importantly, if you look at the 21, it was flat, okay? So it breaks support. And in truth and in fact, we didn't have a complete candle closing back above the 8 EMA. And the direction or the slope of the moving averages can give us some real meaning. If a moving average slope down, it indicates a potential bearish move or further potential bullish move. And if it slope up, it could indicate further advance in price. So if we sit and analyze this carefully, we could have seen that there is always a potential for this to break low. But if we analyze where we are at this point, you'd have noticed that we would have been going into a little bit of what I call an oversold area below 25 on the stochastic. And yes, we crossed the 50 mid-band on the RSI. But here we have to be a little bit careful. We don't buy on the low. One of the techniques that advanced experienced traders would have used is to wait for a bounce back into what we call the value zone. If we are using 821, between the 8 and the 21 here, we call it the value zone. So we'd have wait or anticipate a pullback into the value zone, and we'd have short here instead of here. If we do that, then we could get a little nice down move. Now, if you look at this though, it seems to be pretty much difficult to work with, because you would have a tug of war between the bulls and bears. What I'm going to do in this session then is to show you how we could add additional tool to this. Remember, we are using this session exclusively for the Euro USD. So what we could have done is I could add a few more longer term moving average. I'm going to add a 50, a 100, and a 200. And when I do this, then this technically could give you a complete system, or what I call a complete strategy to execute on the financial markets. And while we use the Euro USD for that, it could be used on any financial instrument, as you see as we go along. What I'm going to do, and we have thousands of strategies, for maybe the next month or so, I want to use the system that we create on this channel to do these commentary, to create these educational videos. So I'm not going to impose our advanced system that have gone through maybe 25 years of improvement, but the essence or the principle, the concept is the same. Only that we might put some little more, a little bit of more ease to the eyes. For example, we're able to stay on one time frame. So for example, we're able to stay here and see what is happening in the monthly, the weekly, and the daily. That doesn't mean that this is not a strategy that you can use for many, many years, for decades. There are many traders who just use even less sophisticated system like this, and they can win more than what they lose in the market. There's some psychology part of it. I'm not going to go through that now. We believe if you are disciplined enough to follow the rule and to stick to it and to analyze your winners and losers, then over time you will experience and reach a stage of what I call the balance zone. When you reach that stage, it means that 1, 2, 3, up to 10, even 50 trade does not change you, because you are totally detached emotionally from your trade. And I want to get a little bit deeper in this. It's important that you use proper position sizing, and we will show you how to do that as we go along. I don't want to touch the position sizing educational video yet, because at this stage we would have deemed person to be trading on a practice account and a demo account, so we don't need to put in all the bits and pieces at the same time. But over time I'll be doing additional videos on that. So let's get into the additional guidance too. So I'm going to add, and yes, you can change these colors. That's why we decided to show you how we do it, so you can do it yourself. You can use this as a foundation to own it, to change it. Every single person have different likes and dislikes. So we're not here to say this is what you must use. No. This is a framework that we are giving you that you can add and subtract from and to make it your own. So I want to add a 50 period exponential moving average applied to the close. I want to put that in blue. I want to add it here. You see what happening here? Okay. You'll notice that I want to call these support lines. This would have been like the 8th support line. I like to describe them according to the visual pattern here. So this is the 8th support, 21 support, 50 support. If you look when price break through the 21 support, if it's above it, then the line below it is deemed as support. Okay, and we're not looking at these support levels yet within the Fibonacci pivot indicator. So when we break the 21, look what happened here. We found support at the 50. See, bounce back from the 50. And if you look at the fractal, as we indicate the tip of fractal, okay? So you'd have seen that we have more confirmation, okay, to show that this could be a support zone. We have the 50 EMA support. We have the Fibonacci pivot support that gives you support 1, 2, and 3. And hence, we could look for a reversal and buy when price rise back above the 8 so that the moving average become orderly. I want to we talk about the order of moving averages. If I look at this, the 8, 21, 50, all these 3 moving averages are upward sloping. And in this framework, we consider the market to be bullish. That means there's a high probability that price will continue to rise. When we reach to a stage like here, we start to have what we call like a tapping effect. Okay, I want to show you how we identify these. If you have the fractal high, a series of them at the top, then this is a visual aid to say we are into a resistance zone. And there's a high probability that price could pull back to support. Now, I'm going to also add the 100 period on this line. I want to put this in green. You'll notice as well that when price was below all these moving averages, then this candle would have been the candle that break all resistance. So when we are here, this is the 8 resistance, this is the 21 resistance line, this is the 100, and this is the 50. Note carefully though that the 50 was above the 100. So this could indicate that we are still in a bullish medium-term trend. Okay, the only crossover we have was the 821. So this could be like a pullback, but the 50 and the 100 was still orderly. So based on that, I would not deem this to be a reversal. Hence, I would not have taken this sell. I will take it as a pullback with an opportunity to buy on the reversal. Okay? Similarly, this crossover, I would not short because the 50 is above the 100. So I would deem this as a pullback in an uptrend. The final one I want to put on is the 200. And this, I believe, would have complete our system. I'm going to put this in red. And we can use this on any time frame. Let's reason. The 200 EMA give you what I call the long-term market sentiment within the trading time frame. We at Global believe in the laws of multiple time frame. And one of the laws indicate that each time frame have its own structure. So here, on this so-called strategy, and strategy number 6, when price is above the 200, we consider the market structure within this time frame to be bullish. Now, over time, I have noted 3 different types of market structure. I want to keep it simple. One would have been a bullish market structure, 2, a bearish market structure, and 3, a market structure where we consolidate, market that's moved sideways. I would consider the formation here to be, I want to go back in time, the formation right here to be a bullish market structure. Why? If you look at the moving averages, they are orderly. The 8 on top of the 21, 21 on top of the 50, 50 on top of the 100, 100 on top of the 200. So we would only take buy signal in this time frame or on this strategy. So for this one, I could, if I want, exit the trade if I'm in profit, or sometimes I allow my hard stop along with the default trading as indicated in the first session. I use the average true range, 14 period, and I use a multiplier of 9 in the sense that I want to trail by 9 times the ATR. So what would have happened? Let's say, for example, we decide to take this trade here. Each move in our favor will adjust the stop loss. So it operates like a ratchet coming up below the price action. I'm going to show you that later on as well. Okay, so I can use that. I use that as a default. Okay, that means that is our hard stop. It doesn't mean that that will be your final stop. But what we want when we enter a trade, we don't know what will happen immediately. So we want to give the trade enough room to run. This does not affect the ultimate loss in monetary terms, because what is the function of your loss is your position size. And later on I will show you in our conservative mode, when we are using strategy 1 that run on the 1 minute, we risk 0.01% of free equity. And 2, we risk 0.02% of free equity. And 3, we risk 0.03. And 4, we risk 0.04. And 5, we risk 0.05. And 6, we risk 0.06. Later on, I will give you a formula to calculate the position size, which means you'll be able to answer the question, how much? How much? And that position size is directly proportional to our stop loss and the percentage risk. So the magnitude of your stop have nothing to do technically with your risk, because we are combining the stop loss point along with the risk. Normally, most literature would say don't risk more than 2% of your trade. I don't risk more than 2% on any one trade. And even 2% is very risky in the sense that you should experience a drawdown. And when you risk 2%, you could experience a drawdown of 40% on your account. And that's why we, from research, from our research team, we designed these default risk model. 0.01% of free equity, 0.02, 0.03, 0.04, 0.05, 0.06, 0.07, 0.08, 0.09. And our stop loss for each time frame is a multiplier that we use 9 times the average true range. And you'll have seen the average true range indicator at the bottom. This is a powerful knowledge for you to save yourself from a lot of issues. Now, there are times persons don't have enough capital if they want to feel what the live market is. And we recommend to do demo. So because we know that there are so many persons who are what we call hot-head trader. They want blood now. They want to see money. Okay, so we can also help you. In that sense, for strategy 1, you must not risk more than 1%. So all we do is to multiply the conservative risk by 100. So 0.01 multiplied by 100, this gives me 1%. So for the so-called aggressive hothead, I call them, no disrespect here, or what we call the risk trader, traders who don't really care too much about losses. They want it now. Then we can help you with that. So for strategy 1 that run on system 1 at the 1 minute, we risk 1%. For 2, we risk 2%, 3%, 4%, 5%, 6%. So, and this so-called strategy 6, we'll be risking 6%. For strategy 7, we risk 7%. For strategy 8, we risk 8%. And for strategy 9, we risk 9%. That's a framework. And for example, when we say we risk 9%, the truth is this: when for strategy 9 that run on the monthly, one trade can last for 1 year, even 2 years. So technically what you are doing is to allocate 9% of your current capital to that strategy. Okay? So the higher the time frame, the longer the duration of the trade we expect. Maybe in my next session I will explain a little bit of how we deal what we call the volatility exposure days or the volatility exposure period. So we believe, based on our framework, that we should allocate risks according to the number of volatility exposure period that you want the trade to withstand. Our default is that we should give each trade 9 volatility exposure period. So if I'm on the 4 hour, I must give the trade 9 4-hour session. If the market move against us by more than 9 VEP, that's what they call volatility exposure period, then we'll have exit the trade. I will compound more on that later on. Now, let me go back to what I now deem this to be a complete moving average system. So instead of the 821 advance, I'm going to call this, I'm going to save this template now as the global moving average trading system. You can call it any name. You could even put your name in it so that you personalize it. So I'm going to call this the global complete moving average trading system. I will just put this, since this is, let's call this version 1.01. Okay, so if later on we update it, we know exactly what it is. And what happened? What happened is that you would now have the advanced 821, which you could deem as a basic system, and now we have the complete, because this could help me now to analyze the Euro USD pair using strategy 6. So here I could go back in time. I said before, I could have, if I take this trade, let's go back to this right here, would have seen that the moving average was orderly. The 8 on top of the 21, 21 on top of the 50, 50 on top of the 100, 100 on top of the 200. Our exposure would have been 9 ATR, and if we just do a quick check, we'll get about 300 pips, so 1.03, way below this point. So this move will still be in the trade. The 9 ATR would allow you to be in the trade up to this point. So if we take, say the 319, 300 from this, you'd have seen that we would have been trailing our stop right here and possibly be close to break even. But you'll see that you will have amplitude time to make that trade decision. Let's say that was the case. If we look here, we'd have seen at this day, which is Saturday the 21st of January, at the close, we close up. The moving averages, all 1, 2, 3, 4, 5 set, was upward sloping. This is a good indication that the momentum is to the upside, and there is a high probability that price will continue to rise. There's also a high probability that we might be able to break above resistance level 3. So this was resistance 3. Based on the momentum here, we believe that we could break above this. So if we go back and look at the indicators, let's look at the what we have thus far. The MACD is above the zero line, positive. See zero line here? Good. The RSI above 50. Remember, when the RSI is above 50, in any time frame, we consider that time frame to be bullish. The stochastic both line is also above 50. You could see the reading here, 70.65, 58.14, okay? And we would have used the ATR is what we use to get the trailing stop, or what we call the trailing stop distance. So for this EURUSD going into next week, I would hold my trade, okay? I would hold this. I would hold my trade. These lines that you are seeing here are actual trade that was being executed. On this particular account, I'm using what I call the global triple play, or some person might call it the global combo. What happened to the global triple play or the combo is that I would combine short-term trade with medium-term and long-term trade. I am currently on strategy 6, which I deem to be medium-term. The short-term is the 1 hour. So if I put this same, so this is 1 hour, let me load that system on the 1 hour. And when we save it, all I need to do is just to go and load it. So let's look what is happening here. And this 1 hour, which should have been your system 5, let's analyze what is happening with the moving average. All 5 are upward sloping. So yes, this strategy would have executed a buy on this. I can also load the daily, which is strategy 7. So let's put that on the daily and load the template. I'm doing this individually to show you, and let me ensure that the template have auto score. The market closed now, so okay, auto score is there. So I just do this to carry back to the head. And if you look at this, we can analyze what is happening. The first thing we look for is orderly moving average. That means moving average in proper order. And the complete system, we take into account all the moving average. So we'd have seen the 8, 21, 50. But look here, this is the 200, but the 100 is below the 200. So we would have possibly wait for this 100 to cross above the 200 and everything become orderly, and then we'd have execute a long-term trade. Okay, note we said a long-term trade with this one. So take this line off. Hence you'd have seen that you would be able to use the various time frame and combine the strategies. What we normally do is we could have the 1 hour first, then we go to the 4 hour, then we go to the daily. These are my preferred time frame for trading moving average strategies like this. I don't sometimes like to go to the lower time frame unless maybe I'm using the global algorithmic trading system that have some additional features to save us from whips or these noise, the level of noise in the lower time frame. I want to talk about that later. Okay, so here we would have had a nice little setting here. We also look at the pivot, Fibonacci pivot indicator. Normally, as indicated to you, that when price go above the pivot line, which is this blue line, it gives us a idea. We call it that we could trade from the long side if it is in line with our market structure. So when price move back above the pivot here and this bar, we could go with a long position. So these give us idea of potential point of reversal. For example, we would highs resistance 3 at 1.0875 because this was previous resistance level here and here. And even though we have a single line, it's not really a one line like a zone, but we are okay to deal with these one line for now. Okay, so going into next week then, based on what we have seen here, we are bullish on the EURUSD, and we will maintain our risk model. So for this, we'll have gone 9 times the 1 hour ATR, which in this case is 70. For this, we'd have gone 9 times the 4 hour ATR, which is 9 times 35. And then for the master one, the daily, we'd have gone 9 times the daily ATR. But with this system and the template I said, you could see the 894 already here for the stop, because we already have an indicator that gives you what the stop loss point in pips should be. For this one, you would have seen 319, and for this one, you have seen 155. Okay, so in this sense, we would have complete the requirement for this session. I could also show you that I could keep one chart. So let me close this, close the daily, and I close the 4 hour. And I can just have this alone here. Because what happens is that I can move from the 1 hour after I analyze what is happening here. I can go to the 4 hour. And when I realize what is happening here, I can go to the daily. Now, normally, I start with the 4 hour, and the 4 hour will give me a good idea, like a midpoint there. But for your research, your weekend research, I sometimes recommend that you could go back to System 9. Look and see what is happening, what have been happening, and this will give you over 10 years span for whatever instrument you are using. I could see on the monthly here that this is really a downtrend, but price move above the 8. So the 8 is serving as support. We could have a reversal. Why? The 21 EMA and the monthly is flat. So this could operate as a resistance point that push back price to retest the 8 EMA line support. One good thing for this momentum trader would have seen that the MACD turned up on the monthly. In the previous session, when the MACD turned up like here, we have a nice rally over nearly a year. When the MACD turned down on this month, look what happened here in 2021. We have nearly 1 year of decline. Here, when the MACD turned down on the monthly, we drop as well. Okay, this was a fake move. Okay, this turn up, we rally. This was somewhat of a fake move, but we could get up to the 21 as a resistance point. See what happened with this one? When we turn up, didn't go much, turn up again, it rallied, hit resistance, and pulled back to retest the previous zone. Over time, we should be able to make good trading decision, or we could aid our trading decision by analyzing these price action around moving average point. Now, I could go to the weekly to get a better shot what is happening close to me in terms of my daily. You'd have seen the 821 crossover, which is a good sign. Take price break above resistance level, the 50 EMA resistance level. Now retesting the 100 resistance level. The moving average is flat, so this could also serve as a resistance point to push back price to retest the 8 and the 50 or the 21. I can go to the daily. Here I'm seeing that it's more orderly, but we have note the 50 is below the 100, is below the 200. So we're going to see a crossover with this. But if I go to if I want to take a trade, I'll note that the only issue I have is with the 100, 200. So I could say, okay, then I could take a trade here. And that's what happened. This would give me a trade. So when you analyze the monthly, you can drill down to see entries. But we want to ensure that your risk is proportional or is a function of a time frame that you are trading. And that's why we create the multiplier constant of 9. Again, I said before, a lot of persons use 2, 3. From my experience, those small multiplier really and truly only work when the market is really trending. In most of the market conditions that we start to experience now, market is more volatile, and hence we have to adjust our exit point to cope for the volatility. So here we are using 9 times, and that we believe would have given the trade enough room. But note, we are not using it as a fix, we're using it as a trailing. So as price move in our direction, we reduce the risk. So 1 hour then become less. This leads us to the end of this another educational video. I hope it was informative, and I also recommend for you to go back to the first, as I'm going to build on each session like this. So until my next session, this is Dr. Brown saying happy trading.